The GDP news from the Bureau of Economic Analysis last month was anything but uplifting. The 2.9% drop in U.S. economic growth in the first quarter was the worst reading since first quarter 2009, which was when the U.S. was stuck in the depths of the Great Recession. This 3% point swing from the BEA's first estimate was also the largest in 12 years. This extreme revision will likely take our current GDP forecast of 2.3% down a notch and even threatens another year of growth under 2%. Hello, I'm Beth Ann Bovino, the U.S. Chief Economist at Standard & Poor's. Normally, a surprising drop of this magnitude would trigger a recession panic, but not this time. Why not? One large reason was that markets had already expected some bad news. We already knew that Mother Nature was partly to blame for the lousy news, with the snowstorms altering spending and investment patterns. To get a sense of how big, ask anyone how many times they had to shovel their car out of the snow this winter. The large unwind in inventories in the first quarter after the unusually large growth readings of inventories in the second half of last year also explains the negative figure. And news from trade reports that the trade gap had widened further certainly alerted markets that the third reading for first quarter GDP would be revised down. But few people were expecting a reading this bad. The big surprise came from spending, which had been one of the few strong elements of first quarter GDP this year than in previous estimates. But with the downward revisions, consumption growth for the first quarter now stands at 1%, down from the 3% rate previously estimated. The change basically comes down to the availability of data. Without the data from the Census Department, the BEA estimated healthcare spending from enrollment data and other sources. When the census data came available, this growth not only vaporized, healthcare services consumption shrank a little bit in the first quarter. But despite the lousy GDP report, we believe that the core underlying strength in the first quarter remains solid. And that helps explain why the jobs market continues to remain strong throughout June. Finally, a number of factors that explain the gap are considered to be temporary, with a likely rebound in growth expected in the next quarter. That gave markets a reason to brush off the report and stay positive. Thanks for tuning in. I'm Beth Ann Bovino at Standard & Poor's.